Okay, hello guys. My name is Joshua. This YouTube channel is Flying On. We're back with another video. Actually, I would say the first video. We're gonna be basically learning much more about forex. I said you came across this video and you wanted to become a forex trader. Yes. And basically, for today we're gonna be learning about a simple strategy that I think I use and most other traders also use. Okay, here's the strategy that we're going to be using. The strategy is called demand supply. So demand supply basically is a strategy which comes out of big moves, because demand and supply, these are points of interest where supply zones transit to a demand zone or vice versa, if you get what I mean. So basically what they are trying to say is, if a big move happens, there's a lot of supply in that position or demand, like I'm about to show you currently. But first, before we start this, let me show you a quick example right over here. So as we all know, the market moves in various directions. We have an uptrend where the market creates highs, higher lows, higher highs, higher lows, higher highs, and higher lows. So basically all these, that's an uptrend. And there's also one which we have called a downtrend. A downtrend is where the market creates lower lows, lower highs, lower lows, lower highs, lower lows. Forgive me for my drawings, they are not accurate enough. Lower highs, lower lows, lower highs. That's for down. And whereas there's also this trend called the sideways trend, where the market just moves in sideways direction. It's indecisive. The market is indecisive, doesn't know yet where to go. Market just moves down, 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 up. Basically just goes like that, like that. That's a sideways trend. So in these trends right over here, if we were to discover, because right now we are talking about demand and supply, so if we were to say it's a demand and supply, we're talking about a strategy called demand and supply. This leads us to this position right over here. Here will be a series of large candles which will make this our demand zone, basically, because it led to the big move. Get it? This move here led to this massive move of much demand and buyers coming into the market. Then it came back here again. This is another demand zone, again creating another massive move. Again another demand zone right over here, creating this massive move again. So basically what they are trying to mean is that when the market comes here, when the market is in an uptrend, avoid trading supply zones when the market is in an uptrend, and avoid trading demand zone when the market is in a downtrend. Because basically right there you're gambling, and this is a probability game. We are trying to look out for best win rates and proper setups. Okay, so here basically this is our demand zone, because it led to this massive move up here. So some traders might look at this retracement, how the market is retracing back down, and comes here, says, this is my supply zone, let me cover up this supply zone right over here. Put this here, this supply zone. Let's say he puts that as his supply zone. Supply zone, he enters, the price comes here, he thinks it's gonna go back down, he enters the trade. What happens? He ends up being stopped out of the market. Price is in an uptrend. That's the reason why. You get it? So avoid trading supply zones in an uptrend and demand zone in a downtrend. Okay. So that's the representation of demand zone. And if we go to this one here, these are the supply zones now. where the market goes and creates a lot of selling pressure to the downside. This is our supply zone, this is our supply zone, and this is our supply zone. Basically, those are the supply zones that we have currently in the market. So the reason why we call these supply zones, the same for demand, this led to a lot of selling pressure. The market came here, covered up all this liquidity that was here at the moment, and made the selling pressure. And also here came back for retracement, covered up this supply zone, went back for selling pressure. Now, how we trade these demand, supply and demand zones? So basically, here in the sideways trend, we don't trade supply and demand because there's nowhere to trade it. You know what I mean? So this one is out of the topic. So how we trade these supply and demand zones? This is how we trade supply and demand zones. Yeah, we're going to show how we trade supply and demand zones. So supply and demand zones are really easy to trade if you understand the concept, because some people might want to add in SMC, such smart money concepts, into this thing. So let's take this as our example. This is an uptrend. Price is creating higher highs, higher lows, higher highs, higher lows, higher highs. So that's our uptrend. Alright, so this uptrend, this is our demand zone right now at the moment. Here, this is our demand zone. So most people would say our demand zone, just because I saw Joshua telling me that if the price is in uptrend and it comes here, it has to hit that demand zone and go back. Yes, that's how we trade demand zones and supply zones. If we are in an uptrend, we have to wait for the price to create this massive move, because while it creates this massive move, it will create either three series of big bullish candles or two. It has to be two or more series of bullish candles. It has to create that V-sharp movement. So if it creates that movement, it has to come back for this to intercept this demand zone or to tap into that part here where that big move started off from. So if the market comes to this demand zone, that's where we start looking for confluences such as candlestick patterns. You can say a bullish engulfing, a doji, shooting star hammery, stuff like that. We wait for it to tap into that position there, that zone, and wait for that big movement. So some people will always, patience, you have to wait for it to tap into that demand zone, but not always it will tap into that demand zone, because you can't accept the price to do that, something like that, okay? So it will either stop around here, and it will come from this demand zone and go up, come back here and go up. So not always every demand zone will have to be tapped in again. And there's also another concept. If we have to understand if that demand zone is valid, it has to sweep liquidity. You get what I mean? If the demand zone is to be valid, it has to have swept liquidity. So what I mean is the demand zone has swept liquidity. Let's say the price came up like this. The price was basically in a downtrend. Price was in a downtrend like that. Price was in a downtrend. Then this was our break of structure, called the price has switched from bearish to bullish. Switching from bearish to bullish, it created our break of structure, coming back to mitigate that zone. After mitigating that zone, it went up. But we see this massive movement up, creating these higher highs, higher lows. This will need to break this break of structure. So how do we know that this demand zone is valid? It has to sweep liquidity. And how do we see if liquidity has been swept? So basically, here in this bearish movement, there was liquidity lying here at this position right over here, at this lower high. When the price came down, all retail traders had put in their sell positions, and their stop loss may be above right over here, something like that. So when the price came, instead of going creating lower highs and lower lows, it came, mitigated this zone, maybe made a sideways trend, came and broke that lower high that was recently created. After breaking this lower high, this is liquidity that has been swept because there's a lot of smart money that was in there. That's when we know smart money has entered the market. So after sweeping this liquidity, the price came back to mitigate this zone again, a retest. So this is when we know this zone has been valid. If the zone is not valid, the market will come. If it has finished creating this big move at this position, the market will come here, come and sweep up this liquidity around over here. This is what we call an inducement. Some traders might see that the demand zone has been broken, so they say, market is heading back to bullish, I should enter for a sell position and put my stop loss above here. No, the market is just sweeping liquidity. So that's when we can enter for a buy here. When the market has finished sweeping liquidity, we may maybe go for a 2 to risk to 1 ratio. Put our stop loss just below this position right over here. Yeah, that's for the uptrend. And now for the downtrend, this is how it looks like. A downtrend, price goes down, creating lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So as I already explained to you, this situation here, this is our supply zone. This is the supply zone that we have currently. That's our supply zone. This one is also our supply zone. And this one is also our supply zone. So all those are our supply zones. So you might have entered the market when the price is already at this position right over here. Most of you had entered the market when the price is at this position over here. You're saying, oh, let me wait for the market to come, retrace this position right there, and then I'll be able to enter for a sell. Yes, that would be the right thing to do, but as I said, look out if the market has swept liquidity at this position. So basically, here, where will the liquidity be lying at? The liquidity will be lying at these lower lows. Yes, at this lower low right over here. Price came up, swept this liquidity right over here. So there is another liquidity line here. So we expect the price to come back here. If it's to create a retracement, we expect it to come, sweep out the liquidity here, then go back to the downside. Basically, that's how demand and supply zones are always going to be working. So, and also another note by is that not all demand zone will be valid at any point of time. You might stay at demand zone or supply zone and it might not be valid. Reason being, it might create a series of candlesticks and sometimes it will not enter the trade. You will not be able to enter the trade because the market did not come and mitigate that zone again or retrace it. So that's why we say you look for another trade. There are always bigger opportunities in the market and you should always be looking out for those bigger opportunities. Basically, that's what demand and supply, the concept is. So let's go over to the charts and take a look at examples. Maybe I show you how to identify these zones and basically you will see how the zones are identified. For me, I prefer, if I'm to trade forex, I prefer top-down analysis, starting off from my bigger time frame, going to the smaller time frame, to the micro time frame. So my bigger time frame is always the daily time frame. My smaller time frame, my higher time frame is always the 4-hour. My smaller is always the 1 hour. Then my micro time frame is the 15 minutes. That's where I take all my entries mostly. So if you look here, I'm just going to be showing you that where the market created a series of demand zones. So if I'm to look closely here, there's a demand zone right over here. Stretch it out. We're going to first be looking for the demand zone. That's our demand zone. Yeah, there's a demand zone there. Where else? What else should I take a look at? Yeah. There's also a demand zone here. There's also a demand zone there. There's also also a demand zone there. There's also a demand zone right over there. So basically, if you understand how to use this concept, it will be easier for you to trade the market if you understand how to capture these demand zones. Yeah. So let me show you the example and how I was explaining this to you at the yeah. So basically, let's start off from this one. Let's start off from this one. Okay, let's record it down. So we see the market is in an uptrend. If the market is in an uptrend, we need to create series of higher highs, higher lows, higher highs, higher lows. That can be way more than twice. Okay. We see the market is creating a series of higher highs, higher lows. Then it broke out of here, came here. That's our most recent high. When creating this series of higher highs, higher lows, it created this demand zone that we have over here. So this is the demand zone that we have currently. So this demand zone, the price came, so we expect the demand zone to be retraced or mitigated again. But what did I tell you? Not every demand zone will be mitigated. The price just came, consolidated here, made a bit of a consolidation, did not mitigate that demand zone. Instead, it continued going higher. So that's why we look for more opportunities. While the price continues to go higher, it will create another demand zone, as we can see right over here. So what I did, I marked out that demand zone. After marking out that demand zone, we see the price came, it created this point here, with this candle here. I don't really remember what it is. It came back down, it made that V shape. This is what we are looking for. If we, after a demand zone, after a big move up to the upside, the price went up, reached here, pushed back down in that V zone, in that demand zone. After that, the price came, mitigated this demand zone, retraced it. So this is where we say we can enter for buys, entries here, because this is our demand zone. We saw a series of big candles heading to the upside. The price came, mitigated this zone. There is a series of confluations right over here. We can see this wick here represents rejection by the buyers to the sellers. The buyers rejected the sellers from entering the market. This is a bullish engulfing. So me as a trader, I would have entered right over here, and I would have set my risks to rewards right there. And remember, the stop loss should always be below the demand zone. So to make our stop loss a bit tighter, we can always look out for entering the zones at a 15-minute time frame and trade the zones a bit tight, make it lower, create that zone tight. Yeah, where is it? Yes, you look for that demand zone right over here. You just reduce the size of that, reduce the size of that zone, because on the 1 hour time frame the candles will always be bigger. So after reducing that size, that means our risk to reward will be reduced like that. That's why I take 15 for my entry points. So that would have been good money entering the market. Yeah, we would have entered with good money right there. And as you know, the market does not stop. It still created another demand zone right over here. Yeah, so basically that's for demand zones. Yeah, so let's look out for the supply zones. Supply zones. This is one. This could be a supply zone, because series of big candles, bearish candles are going in the market. Price came down. Price created this big move down, came back and mitigated this supply zone. That's where I enter my trade from. After creating this big candle right here. Yeah. The same here. There's also another supply zone here. Price came, mitigated it. Yeah, basically that's for demand and supply. So subscribe to this channel, follow up to more videos. We shall be looking out for support and resistance next time we meet again.